Right, ahoy there, and we're live. Excellent, excellent, excellent. Right, so thank you for your patience. If you're looking for something to do with the stock market, swing trading stocks, indexes, forex, commodities, futures, crypto, it all works. All we're trying to do is trade the trend, and that's what we're going to look at today. So again, thank you for your patience while I was just sorting out the technical gubbins behind the scenes. Obviously, I took a week off last week. So we didn't have a session. There are past recordings on the YouTubes. If you're watching this live on YouTube, pop a comment, say hello. If you're watching this with me on Zoom, the chat box is open. So if you've got any questions, comments, observations about swing trading the markets, then just pop them there. If it's relevant, I'll answer them as usual in the moment. So with that said, we do have a little bit of a talking point, but firstly, hello to all our lovely attendees. Adrian, Ashok, Javier, is that right? Javier? Moto G Stylus, hello. That's a bit of a strange name. Is that exactly as it is on your birth certificates? Hello, Solomon, Julie, Tom, and Vito. We're also going to be talking about options strikes. Going to touch on this very briefly. And it's a question that comes up quite regularly because I use stock options as an alternative to trading stock. And quite a few people, again, they ask me questions like, what are they? How do we use them? And I'm just going to go through just some of the basics to get you started. We don't need to know the ins and outs of every possible option, tactic, strategy, widget, whiz bang. It's just unnecessary. As always, with the way that I want to trade, I just want to press the easy button. I want to make it simple for me first. And I want to make the choice as simple as possible. So that's what I'm going to do. I'm just going to show you some of the things that I do just to make it easy. It's systematic, it's replicatable. Anyway, I can see everyone just logging in as we're getting going. So again, we're looking at a swing trade in the markets. If you're expecting to see that, then you're in the right place. If you're looking for underwater basket weaving, then maybe you've clicked on the wrong link. I'm a huge advocate of that trading should be simple. Again, I'm just a poor farm boy who figured a few things out. It happens to be working for the last 28 years for me. And that's what I'm aiming to do in these sessions. I try and give back to my community, either formally or informally, as much as possible. I didn't have anyone to ask when I started out, so that's what I aim to do here in these sessions. My goal is to give you the right tools, the rules, the software to assist you, a community to support you, and of course, a mentor to show you the right way, whether it's formal or informally together, so that you can get results in the fastest and smartest possible way. I refer to what I do as production line trading because that's pretty much what I think of it as. It should be like a production line. It should be by rote, step 1, step 2, step 3, trade on. And that's what we're going to aim to do today. It's a simple rule-based trading system. It's proven. I'll demonstrate that to you later. It's profitable. I'll demonstrate that to you later. It's repeatable. Guess what I'm going to do? I'm going to demonstrate that to you later. And it should take 20 to 30 minutes a day. Now, I appreciate I am a product of my own system. It can take me as little as 10 to 15 minutes to go through everything. But again, I am a product of my own system. While you're learning this process, it may take you a little bit longer. It may take you 30 to 40 minutes. The good news is you can do it at any time of day. You can break it up so you don't have to do it all in one sitting. You can do 10 minutes here, 10 minutes there, you know, wherever you can squeeze it in. And if you want to spend longer doing it, you obviously can do. I just don't want to spend all day, every day flicking through charts like a mindless zombie. One of the things that I teach is to trade the trend. As always, my favorite slide at the moment is I don't think BTFD means what you think it means. And all I mean by that is everyone says buy the dip, and the media's the worst for it. They go buy the dip, buy the dip, buy the dip, or sell the rally for that matter. You're in a downtrend, or they say something that is effectively meaningless. Like, what does that mean? I'm always reminded of the, do you remember that 1986 popular movie with Tom Cruise in called Cocktail, and he gets a job at a bar and he's asked for a martini, and he immediately asks, like, what's in that? It's like, if you don't know, you don't know. But like, if you just ask somebody for, again, insert the name of cocktail or a cocktail, it's we need to know the components that go into it. So buy the dip is the name of the thing, but what we want to know is the components that allow us to buy the dip. And it's a silly little thing. It's a simple little thing for that matter. All we need to do is to qualify the trend so that you can buy the dip. Because if there's no trend, specifically an uptrend, then there's no dip to buy. So it seems obvious when we say that, but very few people do it. So I'm going to show you how to find a buyable dip. And at the moment, we can also look for sellable rallies during a bear movement. More specifically, we want to know if a dip is worth buying. It's backed by irrefutable data. If you plug the rules that I described to you into a computer program, which you can see here, I can click the button for you in a moment with my software. What we should be able to demonstrate is a positive expectation, a steady equity curve. An edge in the markets, if you will. And these are all things that we're going to explore in just a moment. So if you are new, firstly, I should option strike. Option strike sections. So if you are new to these sessions, the agenda is we're going to spend about 60 minutes together. You're going to listen to me talk at you for about an hour on the markets. If you want to talk with me, pop a comment in the chat box, either on the Zoom or live on the YouTubes. I will see them when I get there. They're on my other monitor. And again, if you've got any stocks that you'd like me to look at, if you're looking at something and you want me to run it through my algo, I'll happily do that for you. So we can see if it's worth trading them. I'm going to spend 2 minutes just to introduce myself. If you've not seen me or heard my funny accent before, I do talk fast, so just think faster and you will keep up with each other. We're going to go through the markets, see what's going on. And more importantly, Phil is going to get some spelling lessons later on. So the feature part of the show is we're going to look at option strike selections. I'm just going to spend a little while. I'm not going to go too heavy into it. And certainly I don't want to go full nerd on it, but just show you how to get how to choose an option strike or how to choose an option strike that makes sense. Again, what I do is trade options as an alternative to trading stock. So that's what I'm going to show you how I do. And as always, there is a commercial intent warning. I'm a trader first. I also am an educator. You can work with me on a more formalized basis. If you don't want to and you get everything that you need from these open sessions, that's cool. But if you would like to go further, faster, smarter with a mentor showing you and guiding you the way, then we can work together. And this is as hard pitch as you're going to get from me. I've been doing this for 28 years. If you want to work with me, you can. If you don't, that's cool as well. I'm not going to twist anyone's arm into doing it, but all my students get results, and that is my promise and commitment to you. I will work with you until it's working. I have a lot of success stories in both up and down markets. Again, if you are new to these sessions, the best way to get value is to interact. Like, comment, share, ask a question in the chat box, and we'll answer them as soon as I see them. As usual, quick warning, there are no diamond hands. There will be no going to the moon. I'm going to show you rules, really boring production line rules. It's going to be a factory operation. Factories aren't exciting. There's lots of health and safety measures. There's people with clipboards going around and making sure that we're all doing what we're supposed to do. And that's what trading should be. It is for me, because what I don't want to do, what I hate doing is sitting at the computer like a mindless zombie, doing the stock market equivalent of Where's Wally, flicking through chart after chart after chart after chart, wondering if the next one's going to be the one. And what I'm trying to avoid is the experience of where's the trade. We've all done it. I've done it in the past, and this was kind of like my journey to getting where I'm going. I'm sure you've done the same thing. I want to avoid that where's the trade experience, because there's nothing worse than sitting at the charts wondering, is this going to work? You know, it's a horrible experience. What I want to do is I want to go, there is the trade. And that's what rules allow me to do. Rules allow me to go, you know what, there's the trade right there. These conditions have been met. Step 1, step 2, step 3, there's the trade right there. And that's what I'm looking to do. And that's what rules do for me. Rules are boring, but rules make money. I've obviously get my own results. You can see some examples there. I used to post a daily newsletter. I don't anymore. I'd rather just like show you what I do rather than basically I'd rather teach you how to fish than give you a meal for the day. But nonetheless, that's what I aim to do in these open sessions, and basically show you how to find great trades before they actually move. Some of them work, some of them make money, some of them don't. On average, over multiple occurrences, I'm aiming to make an on average return on the capital that I use. So that's what we're going to look at in just a moment. Quick 2 minutes on who I am, in case you've never heard of me before. My name is Philip Newton. I'm the guy with the weird accent behind the microphone. I like cake, coffee, walks. I've got a strange affinity for flamingos. And just yesterday, I went to a local zoo. I saw baby flamingos for the first time. They're little white, fluffy buggers. But nonetheless, I don't know why I've got a thing for them, but nonetheless, that is my weird, quirky thing. I am just a regular guy. I said to a colleague of mine just this morning, I'm long on time and it's by design. I want to spend as little time as possible at the computer doing the chart thing, so that I can enjoy myself, so that I can go and have experiences, so that I can spend time away from the market, and more importantly, not worry about what the market's going to do. And it's this process that I'm going to describe to you in just a moment that has allowed that for me. I've been very fortunate to have been moderately successful in what I do. So again, I've been trading since the 90s, hand-drawn charts, or started hand-drawn charts in the 90s, and I've been doing this full-time for over 20 years now and helping good people like you become great traders. I am not a Wall Street guru. You should most definitely not listen to me. I've got to say this. You should most definitely not listen to me. I'm not a financial advisor. Your money is your money. My money is my money. I'm going to show you what I do with my money, and if you want to do something similar, that is totally up to you. What I can do is show you the benefits of my practical in the trenches experience. Again, I'm going to show you what I do. And again, if you want to do something similar, that's okay as well. Past performance is no guarantee of future performance. That's the legal beagle part. What I can do as well is, because of the power of computers and algorithms, etc., I can show you that while past performance is no guarantee of future performance, they do sing from the same song sheet. So that's what we'll do. I have cracked the code, and it's not just me saying that, it's my students telling me that. My students get results. Again, I am very proud of the fact that I've worked with many, many people, thousands of people, in fact, over the years, and they consistently tell me on a regular basis the results that they're getting. That's what you're seeing here, all the comments that people have posted recently and this year to get results. What we're going to look at today is just a small part of the production line trading system that I talk about. I'm going to show you my number 1 and number 2 money-making pattern. Again, as I've just mentioned, it is a part of a larger process. Again, my goal with these sessions, if you're just coming into the room today, is to give you the tools, the rules, the software to assist you, provide a community to support you, and a mentor to show you the right way, so that you don't have to make all the pitfalls and mistakes that I made with the trial and error method. It certainly took me a lot longer to get where I was, because that was the approach that I took, and I don't want that for you. It is the hard path, but I want each and every one of you to get results in the fastest and the smartest possible way. And a quick reminder, if you do want to work more closely with me, you can. And again, that is the hard pitch. If you don't want to, that's cool as well. So let's get into it. Let's look at option strikes. One of the things that I do is, instead of trading stock, which can be quite capital intensive, which kind of forces you to trade one thing, one stock at a time, then we can use stock options as an alternative. I do use them on margin, but I don't use it leveraged. There is a difference. I use it as a discount as opposed to a multiplier. So if I want to risk $1,000, for example, and again, you can pick your number, whatever your number is. I'm just picking a number for a quick illustration. If you want to risk $1,000, you can buy an option that costs $10. $10 will control, or $10 per share more specifically. It will allow you to control one option contract. And every option contract controls 100 shares. So a $10 option would be 1,000, or times 100 shares would be $1,000. So this means that it's fixed risk. Oops, sorry, I've just skipped the slide. So it allows us this flexibility. Sorry, I'm kind of going ahead there. The slides aren't catching up. I had this fancy little slide here just because I've got Star Wars nerd. You can strike me down. So the option strikes. Oh, well, the joke's been missed. Was there a joke there? I don't know. what are options? There we go. So my apologies, just missed a few slides. So an option, for want of a better description, I appreciate it's not entirely accurate. So before I say it, if you do know what an option is, don't roll your eyes at this. This is primarily for the new people who have never thought about them before. But an option is kind of like a deposit. The worst that can happen is you lose your deposits. It's fixed risk. And what I was just suggesting is that the price of an option is a defined risk. So for me, this means that I don't need a traditional stop loss. If my risk is defined on entry to $1,000, then that is fixed to $1,000. I don't need a stop loss. And this means that I can mistime an entry. I don't have to worry about retracing. I don't have to worry about being stopped out. As long as the thing that I expect the stock to do happens, then I should be able to get paid somewhere. So it's a fixed risk alternative to trading stock. And more importantly, if you've got a margin account, your $1,000 risk is all it's going to cost you. So instead of having to put up a percentage of the stock's value for margin requirements, which locks up or can lock up a lot of capital, then your fixed risk trade is fixed risk. That's your risk is your cost and your cost is your risk. If you're familiar with the option graph, it looks like this. And this is what this means in the option world. Let me just get my little drawing widgets. There we go. So this is the, so usually along the center line here, this is the stock's price. So if the stock was to go up in value, then that would be what we're looking at here. So the price of the option, may be here. So if the stock goes up, then the option will go up in valuation proportionally. Now, if the stock goes down, if this stock went to zero, your risk is fixed. And that's what we're seeing here. So you will lose money, but the pain stops. So you cannot lose any more than the price of the option. So before I go any further, does that make sense? Again, if the stock goes up by $100, you will get a proportional value. You won't get all of it. You'll get a proportional value of the stock's movements. So we get most of the benefit of the upside, but we get a fixed downside risk. So if the stock went from, say, $50 to zero, it turned out to be Enron, the worst that could happen is I lose my $1,000 or whatever the risk is. Again, you can go from $50 to $500 to $5,000. You can find your sweet spots with options as well. So does that make sense? Your risk is fixed, is what I'm trying to demonstrate. Gonna take a quick drink because my throat's a little dry and just check the chat. Hello, Glenn. I see you watching on YouTube. We're also going on Zoom. I know you normally go on the Zooms with us as well. So, Elena. Hello, Nick. I've got a few new faces. I'm just casting my eyes down. Hello, Rick. Rodrigo, been a while. Haven't seen you for a few weeks. And Vito YB again. Lots of new faces there. Excellent, excellent. I don't see any questions, so let's move on. So this is, again, what you'll typically see in the textbook. And that's all this graph means is if the stock goes up, the option will profit proportionally. And if the stock goes down, you will, as always, you will lose money if your trade idea doesn't work, but it's fixed. And this means that I don't need a stop loss. I can give the trade idea the full measure of time that I have. Now, the next thing that you want to consider is, let's just say that you've chosen a stock and you like it, and then you're often presented with something that looks like this. Now, this is called the option chain, kind of like a crazy ass spreadsheet. But what you want to look at on the left, first of all, and again, I've got one of the option chains open. And this is from a while ago, so you don't worry too much about the dates. But you're usually presented with an option chain, just like a spreadsheet. And what I want to do is I want to choose an option with sufficient time. Now, I've just chosen one of them here when I took the screenshot with 49 days. The way I like to trade at the moment is I want plenty of time on the clock. I want at least 150 days to expiration. So again, just like a deposit in the real world, there's an expiration date. Let's just do a quick real world comparison. If I was to go to a car dealership and I liked a car, it's got all the spec, the right color, everything that I want, but I want to make sure that I get that particular car, I'll say to the car dealer, can you reserve the car for me? And they're going to say, sure, if you just leave a deposit, we will reserve it for you. That's essentially what we're doing in the stock market world. So options are no different to things that we would do in the real world. We're just doing the stock market equivalent. So an option allows me to reserve 100 shares. Now, let's just go back to our car dealer for a moment. If it turned out that some major celebrity previously owned that car, then the valuation of that car might go from the regular price to, holy shit, Elton John used to own this. And it might go from $10,000 to $50,000. But remember, you control the car at its original price. You've reserved it at that price, the old price. So you can buy it at the lower price and sell it at the new price. That's all we're going to. Now, another way of doing that would be, well, you can sell the deposit to someone else. Now, if you know anything about cars, this happens with some of the big brands, the limited brands, like what is it? Like a Ferrari, limited edition Ferrari or something. Like there's only going to be 1,000 made, for example. And quite literally, this happens. People reserve the car, they buy in advance, they pay deposits, and they get a number between 1 and 1,000, depending on when they reserved their fancy Ferrari. And what people do is the closer that they get to delivery, then the greater the value of the reservation, the deposit, the option. And they'll sell their place in the queue to someone else so that they don't have to wait. They don't have to be number 900. They can jump to the front and be number 2. Yeah, I'm going to get mine next. And that option value will increase the closer we get. So we're doing something similar. Now, when the stock moves up, the value of the option will increase. So again, I'm just trying to demonstrate it's real world value. So what I want to do is I want to make sure that I've got enough time for my trade idea to work. Now, by doing this, I also avoid a lot of the shenanigans, shall we say, that come with near-dated expirations. And I'll just park that comment there. If you get it, great. If you don't, let's not worry about it today. But I want to make sure I've got enough time on the clock is the point. So then if I've got 150 days to expiration, plenty of time for the trade to play out, I've then got the choice of, well, I'm now presented with all of these strikes down the center. So the next place I'm going to look at is down the center. Okay, what price should I reserve my my stock? Again, the way I like to do it is I like to, let me just clear the screen. The way I like to do it is I've got a choice of three options. So I'm going to use something called Delta to help me figure out what I should do. So on the left-hand side, we're looking at calls. On the right side is puts. It would just be the inverted thing. So I'm just going to focus on a bullish trade. We want the stock to go up. Again, I've got 3 choices, and this simplifies it hopefully greatly for me. Like, which one do we choose? Well, the classic stock replacement strategy is to buy what's known as an in-the-money option. Again, if these are all new terms for you, don't worry about them. You can Google them later. I just want to go through it reasonably quick just to expose you to these ideas. But you're going to buy an option that is in the money. And you can go to around about the 70 delta. So you can use delta to measure where should I purchase the strike. So that will be the classic stock replacement strategy. So what that means is the option has sufficient value in it to behave like stock. So as an alternative to buying stock, you can buy an option that behaves as if it's stock, meaning if it goes up $1, the value of the option is going to move not exactly $1, but it's going to move maybe 70 cents, 80 cents. It's going to have a significantly correlated proportional value. You can also go the other way. I'm not usually a fan of this one. There's a time and a place for it, but some people buy out the money options. Now, what you don't want to do is go too far out the money, because when you go too far away from the current stock price, away from the stock price, out the money, then you're buying lottery tickets. So we can go to around about the 30 delta level. 30 delta as our, I'm going to buy an out the money option. I don't want to buy a lottery ticket, but it will mean that I get a lower price point, a lower cost to the option. So approximately the 30 delta option is a good point to consider an out the money. You certainly don't want to buy 10 delta. That would be like a lottery ticket. You had a lot of people buying lots of what essentially is junk options, and you need a huge stock movements for them to benefit. It happens often enough to make it interesting for people to consider, but it doesn't happen on a regular basis. So just keep that in mind. So 30 delta is as far out the money or away from the stock price that I would buy if I'm going to apply this. Now, my personal preference, let me just tidy the chart. I'm using a new drawing tool, a new setup, so just bear with me. Everything's in different places I mentioned earlier. So the one that I prefer is the at the money option, this yellow one here. So the at the money option, so that's going to be around about 50 delta, and specifically it's the first strike out the money. Again, if you get that, that's great. If you don't, these are all new terminologies. Again, don't worry too much about it. You can go and Google them, but it's basically the one right next to the current stock price, the one right next to the current stock price. That's what the at the money option is. And this means that I'm only buying time. It will have the least costs, but will start to benefit the soonest if my trade idea is right. And that's what I like to do. Cool. Right. So, quick view of the graph, if you like, the graph of the delta of the options, what we're going to talk about. This is as nerdy as I'm going to get. The delta of the options. So if you buy, where's my drawing widgets? Here we go. So if you buy the 70 delta option, and this has got a lot of valuation in it already. So if the stock goes up by $1, then the 70 delta option should increase in value by 70 cents. So this is what I meant earlier. It's going to behave like stock. It's not exactly, but it's close enough to have this synthetic appeal. And this is the classic stock replacement strategy that I mentioned earlier. The out the money option has where's my, sorry, still trying to get used to this new setup. The out the money option, so this would be the at the money, that would be in the money, that would be out the money right there. So the at the money option, you're buying 30 delta. So if the stock goes up by $1, then the option will make 30 cents. Now, the next dollar, if you can imagine, you're only initially buying it by 30 cents. So why would you do this? Because if the stock moves $1, the new valuation of the delta might be 40. So the next dollar movements would go to, the next $1 stock move, the option would increase in value by 40 cents. So then we're now at the money. So the next valuation is 50 delta. So the next $1, you see where we're going with this, the next $1 move up, then the value of the option you'd get 50 cents of that $1 move. Again, all the way down to our 80 delta that we were just talking about. I should have put the slides the other way around. That would probably have made more sense. I will know for next time. Right, so that's what we're showing here. So I like to do the at the money, the one in yellow. So I like to do this one here. So the stock is effectively, let's just say 50 delta. So the first dollar is going to make me 50 cents, and then it will start to accelerate in the money, and then I get more and more valuation the further the stock moves. That's what I like to. That's my personal preference. And just so we know, oh, God, I've not cleared the chart. There we go. And just so we know, you've got the yellow one there. It's the one right next to the current stock price is what we're looking at. And this is the profile for that long call that we're just talking about. So if the stock goes, or looking at it again, if the stock goes up in value, then my option will go up in value proportionally. And that was the measured by the delta that we just looked at. So again, if you're buying a 50 delta option, the at the money, the first dollar goes up by 50 cents. And let's just say the next, $1 move, if you've got, you're going to have some extra valuation on the delta. So maybe you've got a 60 delta option now. So the next dollar move will go up by 60 cents and so on and so on and so on. And that's what we've shown on the previous slide. Right, I think that's it. So options. So it's a very long-winded way to say I'm going to buy the at the money option. It's the first strike out the money. I want to make sure I've got plenty of time on the clock. And this is my version of an alternative to stock replacement strategy. I want to buy the at the money so that I don't have to use a stop loss. If you buy in the money, you will have to treat it like stock and use a stop loss. If you buy out the money, there's a little bit of a distance for the stock to travel before it starts to benefit by any great measure. So there we go. There's my quick back of the envelope introduction to options and the way that I like to do them and why I'm doing it. Hopefully that all makes sense. I'll just pause for a quick drink break. Any questions at this stage? Otherwise, let's go and look at the charts. If you're just stepping into this, don't be put off by options and some of the nerdy stuff that we just went through. It's a steep learning curve, but it's well worth getting to grips with it. And again, just to kind of recap the earlier comments, an option, they are brand new for you, again, it's like a deposit on, if you were going to reserve a car, as you mentioned earlier, it's just like a deposit in the real world. You want to reserve a car, you place a deposit, you control the car for 30, 60, 90 days, however long you buy the deposit for. And all we're doing is the stock market equivalent of deposits. There's a few more moving parts to it, as you just saw, but by knowing these things now, you're down to three choices. I'm either going to buy at the money, in the money, or out the money at either the 70, 50, or 30 delta levels. And it keeps it nice and simple. And it just means that montage of database or spreadsheet of weird numbers, you can just zero in on, okay, the three things that make sense. Make sure you've got enough time and make sure that you're either in, at, or out the money at one of three levels. And that's how I choose my strikes. Quick drink and let's go and look at the charts. Slurp. Right, let's do it. Let's go and nerd on the charts. So while we're doing that, let me just check the chat box. Is there any questions about that, or do you have any stocks that you would like me to review? If not, I will just explain the production line strategy that I like to use. Cool. Don't see anything for the moment. Perfect. Right, so I'm going to put that drawing tool there. Okay, so as I mentioned at the top of the session, I like to refer to what I do as production line trading. I've got what I believe to be a simple set of rules. There are 4 rules to determining a trend, 3 of them to determine the trend, and 1 of them to determine a buyable dip. And the opposite is a sellable rally. So we're going to look at 2 of my money-making patterns. The first thing we need to know is I'm using a 200, 50, and 20-period moving average. As I say almost every week, there is nothing magical about the moving averages. There is nothing magical about the settings. It's just a standard set of indicators that allows me a mechanical way to evaluate price. We can all agree that when price is above the 200, the 50, and the 20, we can all agree that when that happens, round out here, that price is above the 20, the 200, and the 50. It is a statement of fact. And when it's between the 50 and the 200, then it is between the 50 and the 200. It is a statement of fact. There is no ambiguity. There is no difference of opinion between your interpretation and my interpretation. It's not an interpretation. It is a statement of fact. There is no such thing as overbought or oversold. Again, I'm going to say it one last time. It is a statement of fact. So what I'm looking for initially is when the 200, the 50 is above the 200 and the 20 is above the 50. Basically, all 3 are stacked nicely on top of each other. I'm going to say that I have a bullish directional bias, a mechanical directional trend. In this case, I'm bullish. I'm going to bias all my decisions to being long, bullish. So that means that when price moves down, we have a dip opportunity. Now, to not worry about every down day and get, oh my God, it's a down day, it's a dip, buy the dip, and go crazy like the media would have you do, I'm going to ignore everything that is not between the 50 and the 200. So my dip buying opportunities needs to come back into the 20, sorry, back into the 50, back into the 50, back into the 50, back into the 50. So that means that if it's not coming to or between the 50 and the 200 moving average, then I'm not interested. And it means that I don't have to sit and watch every price fluctuation and wonder, is this 0.5 percentage point lower? Is this a dip buying opportunity? Will it move 1 or 2 or 3 percentage points lower? Is that a dip buying opportunity? Well, I don't have to worry about it because I've just quantified what a trend is and what a buyable dip will look like. So let's look at that again. So my directional bias is bullish. I will be a buyer or my dip buying opportunity is as it goes below the 50, and as it accelerates back above the 50, then that is my profit opportunity. So back to the 50, and as it moves away from the 50, that is my profitable opportunity. Back to the 50, that is my profitable opportunity. Back to the 50, that is my profitable opportunity. Can everyone kind of see this now that I'm just pointing it out? I'm just avoiding all the noise. Back to the 50, back to 50, away from the 50, and that is my profit opportunity. And as you can see here, they don't all work out. There's a couple that go back away, get stopped out. We eventually see price change direction. So the direction changed just there. The 50 went below the 200. So now here I'm going to be bearish, meaning that I'll profit from downward movements in the markets. Great. Back to the 50, away from the 50. That's my profit opportunity. Back to the 50, away from the 50. Profit opportunity. What is it doing now? It's back above the 50. The 50 is there. And when it moves away, that's going to be my profit opportunity. So I'm waiting for that to happen. This is what a sellable rally looks like. Let me press pause. Does everyone get this? Let me check in. Does everyone get this? Simple concept. 3 rules for the trend, 1 for the dip, 1 for the Bible dip. There's 4 rules to this. Now, when you have that codified and quantified, this thing gone? No. When you have this codified and quantified, what I can start to do is I can start to plug those rules into an algorithm, which is a fancy way of saying, if this condition happens, this series of conditions happens. I am just gone back to the S&P. I thought I was on it. I was on the down. Makes no difference. It's effectively the same thing. But if I just did that, the buy the dip, the sell the rally, as I've just described, if I plug those rules in with a little bit more refinement, because I appreciate you're getting the back of the envelope version for speed today. If I just plug those rules in, add in the money management that I like to use, then I can say what would have happened if I'd just done that and nothing else, and didn't look at the news, didn't look at the media, didn't look at what the Fed is doing, nothing. If I just did a completely automated decision-making process, what would have happened? Click. Do I have a positive expectancy strategy? Well, now what we're looking at is a historical performance report over the last 22 years. And if I'd put a fixed amount of money in, there's the 0 line. If I'd put a fixed amount of money in, the dollar doesn't matter. All I'm looking for is there a steady equity curve? It looks just like the trend is charting, but this is now a historical representation, a back test of the performance report. If I just did and applied the rules that I've just described you with a little bit more definition, laid on the money management that I like, entries, exits, stops, and targets, what would have happened? Well, I think we can all agree that we would have made some money. Great. This is what an edge looks like. This is a positive expectancy. This means that don't have to worry about, will this one work? Well, I don't need to worry about the one because on average, I'm going to make money. What I'm trying to do is not cherry pick one trade and hope that it works, which is what most people do. I'm just trying to focus in on which stocks behave favorably for the way that I want to trade. I want to trade swing trading. I want to get paid at the end of 30, 60, or 90-day cycles. I want to do it without spending hours flicking through thousands of charts. I want to basically farm the setups. I don't know any more than the next person which trade will work next. So I've got to take every opportunity that comes my way so that I can emulate this performance. That last part makes sense. That's probably one of the more important parts. I want to emulate the performance. I don't know which trade's going to work. No one knows which one's going to work. So I've got to take the setups when they set up. And if you can just about see it, that's what these little arrows are. Bible dip, Bible dip, the algo, Bible dip, Bible dip, Bible dip, Bible dip, Bible dip, Bible dip. Now, some of them lost money. Let me just highlight the ones that lost money. That one lost money. That one lost money. This one lost money. But all the others, oops, a daisy, made some money, made some money, made some money, made some money, made some money. And there we go. So I'm sure we can all agree that it's an on average return that's important. And around about this time, I usually compare it once again to the real world of business. If we opened a shop on the high street, if we opened a shoe shop on the high street and we called it Flamingos Phil's Fancy Shoes, you would not expect one customer to come in every day and buy one of every color, one of every size. And the moonshots, the 10-bagger, in the stock market world, you would think it would be crazy. Some of those customers are going to come in and ask for refunds. There's your refunds. Some of them are going to take, I'll have just one of the size 9, one of the size 5s, one of the size 9s. Oh, actually, someone's bought 2 things there because the profit's a little bit more. It's actually, half, the usual potential. So the profit and loss is going to be variable, but on average, just like any real world business, you've got an on average return when you take in the profits, the losses, the refunds, the write-offs. Just like any real world business will do, then it's an on average return. But for some reason, as soon as we step into the world of the stock market, everyone expects every trade, every day to work out perfectly and be a 10-bagger or go to the moon because they were trying to diamond hand it because they read it on some forum. But no business works like that. We want to do the equivalent, the stock market equivalent of operating a steady, consistent business that opens 9 to 5, has well-stocked shelves, and we've got plenty of customers. Some of them are going to ask for refunds. But on average, at the end of the month, the quarter, the year, we're going to make an on average return, just like any other business. Cool. That's all we're trying to do. With that said, let's go and look for some trades. So now you know all of that. Now you know this. We can speed things up. The last part to this is to trade a portfolio. So what we're looking at here, here's my top 25 stocks. So what I've done is I've gone through, and this is the only time-consuming part, I've gone through a lot of stocks that have liquidity, that have options, that behave favorably, and I've plugged them all one at a time through the algo. And I found several hundred stocks that have performance similar to what I've just shown you. They have a steady equity curve. Because again, not every stock is worth trading. So I'm going to focus on what I consider to be the best stocks and then take that list to the top 25. So now my whole universe is 25 stocks. Now what that means is I will never miss a trade. That's pretty cool because I'm only looking for opportunities on 25 stocks. Oh, where's my drawing widget? Oh, I think I've done something to my pen. Just bear with me. Let's get rid of that. Okay. So I'm only trying to find opportunities on a small number of candidates that make sense to look for a small number of trades on. There we go. There's my drawing thing. Let me just park that. Let me just park that there. Okay. So I'm only looking for a small number of opportunities that make sense. The top 25. I'm going to farm the settings. What I mean by that, as I said earlier, I don't know which stocks are going to work. I just know that they're going to work on average. So I've got to wait for the setups and take them as they come. So I can sort all the stocks. So these columns here, my little radar screen dashboard is telling me which of these stocks are bullish and which of these stocks are bearish. That's the average price crossover. So we've only got a small number of stocks at the moment that are in a bullish directional bias, and there are stocks that are going up despite the markets. And there's a few more stocks that are bearish. Great. So you're always going to have a division, a split of stocks that are biased on the bullish side and biased on the bearish side. And that's the nature of things. So what I can do is I can determine, okay, which of these stocks is dip buying opportunities. Let's take a look at LNG. And I can see here, right there, I've got blue, blue, blue. It's above, it's in a bullish bias. It's above the 200, the 50, the 20. So I can see which stocks are in a bullish bias and which stocks are retracing. So this bullish trade here, we've got red, red, blue. So it's above the 50, above the 2, my apologies. It's in a bullish directional bias. It's above the 50, but it's below, it's dipping below the 50 and the 20. So we've just seen that same thing happen, or not last week, the week before, we would have seen that happen. So you're going to have price rally and retrace. It's below, or it was below the 50, it's above the 200, and it's just gone back above. There's that profit potential on LNG. That is now moved from a dip buying opportunity to a buyable dip. It's now resuming its upward trend. Cool. Who wants a piece? Let's take a look. Oops. With me. Let's take a look at ABC. So let's take a look. Is ABC a buyable dip? Yeah. So we've got red, red, blue. So what that means is the right there, the red. Let's change the color. So the red there below the 20, below the 50, it's above the 200, but we're in a bullish directional bias. That's what those numbers are. And they're all on the headers there. So we've got price dipping below the 50. It's below the 200. It's still above, my apologies, the 20. It's above the 50. So what we're waiting for, what I'm waiting for, is for price to accelerate back above all 3 moving averages in the context of a trend. So now we've got a dip buying opportunity, but it's not yet a buyable dip. Does everyone understand the distinction? It needs to accelerate upwards, line in the sand. So it needs to go above, say, $150, and then I'll be all over that, as the kids say. Do the kids say that? Well, they do now. In my world, they do. Oh, dear. So that's it. That's what I'm looking for. That's all I'm trying to figure out. So I've got a couple of opportunities that are worth buying, dip buying opportunities. So with ABC, it's not no, it's just not today. Let's check out, what have we got? CVX. So we've got a couple more here. We've got dip buying opportunities. Same thing. We've got a dip buying opportunity. It needs to go above, say, $160, and we'll have ourselves a buyable dip. Let's check out COP. Unsurprisingly, the energy sector is, if you'll pardon the pun, hot. Again, we've got a lovely bullish trend. We've got price dipping. It's not yet a buyable dip. It needs to go back above, let's just say, $100 approximately. Don't worry about the pennies. Just get the concept right. And similarly, we're looking for sellable rallies. So we can also profit from bearish movements in the market. We've got lots of rallies at the moment on the bearish side of the ledger. Let's check it out. HPQ, we've got the average prices crossing over. It looks like we've got a rally in what could be the start of a new downtrend. Looking interesting. AMAT, we've got price in a downtrend. We've got a lovely rally in a downtrend. So when price goes below, let's just say $100 or back again below $100, we've got a sellable rally. We can profit from a downtrend when it starts to resume the downtrend. AMAT. We've got a newly established downtrend. We're back above the 50. Does everyone get this? When you know the concepts, when you know the rules, you can see how it becomes a 10-minute job. Average prices cross down, prices pushing lower. It's now rallying back between the averages. That's a rally in a downtrend. To make it a sellable rally, price needs to go back below the averages. Easy peasy, lemon squeezy. Even my categories, don't you? Yep, you do. Perfect. So there we go. So we've got some interesting opportunities. We've got a couple of Bible dips. We've got a couple of sellable rallies. And it becomes easy to manage. Again, you're only looking, you would start off with your top 25. You're going to farm the setups. You're going to wait for the setups to occur. You're going to have a balance of bullish trades. You're going to have a balance of bearish trades. It then won't matter if the market's going up or down. You'll profit on the upswings and the downswings in the markets. That's it. Mic drop time. Any questions on this for the moment? Any questions for the moment? For a change, I've actually managed to get through it a little bit ahead of schedule. When you've got used to your top 25, you can progress to a top 50. You can add in more opportunities. Should you choose to, you can do that. Question about earnings. Do we need to worry about earnings? We're in earnings season. I do not look at earnings anymore. The algo that I showed you does not consider any news, doesn't care what Cramer was talking about. It doesn't care what the interest rates are. It doesn't care about inflation. It just looks at what would have happened if we'd bought the dip and sold the rally. Now, the exception to the rule is if I do have a Bible dip or a sellable rally and I happen to go and place my trade and I notice that earnings is tomorrow, I'm probably going to wait a day. And that's the only exception to the rule. A little bit of common sense. It's a personal preference, but we've got to apply that from time to time. It's not going to make a huge difference. Most times earnings, and as always, exceptions to every rule, most time earnings is a non-event. So, but what we don't want to do is buy overinflated options. Again, if earnings is tomorrow, I'll probably just wait a day. A little bit of common sense. That's the only exception to the rule. Right. With that said, I'm pretty much, I've finished early for a change, folks. Have you got any questions, comments? Have you got any stocks that you want me to look at? If it's your first time, say hello. Pop a little yoo-hoo in the chat box. The hard part about what I do at the moment, folks, is finding a new and creative way to say buy the dip or sell the rally. It gives me no end of amusement. I could sit here and I can draw lines all over the charts, and I can draw the Dow theory, the GAN theory, the Elliott wave theory. I can draw head and shoulders pattern. I actually thought I was seeing one unfold on oil actually earlier. I can draw the patterns, the inverted head and shoulders, the wedges, the wedgies, the flags, the pennants, the diamond patterns. You know, it's all subjective. It really is all subjective. And there's a time and a place for all of those things. But I don't need to do them. As I've just demonstrated, I don't need to do them. Now, the best way to think about discretion is determine that you've got a trade, first of all. So I'm looking at crude oil. You've got very clear a dip buying opportunity. The 50 period moving average is there. So it's got to go back above, say, 105. And that would be your Bible dip. Right now, it's doing this little, what could be this head and shoulders pattern, inverted head and shoulders pattern, more importantly. So that could be head and shoulders as a potential continuation to the trend. I can do all of that. I could spend hours doing it, but you know, I just don't want to do it. It's not essential to the process. If you want to layer it on and you want to refine an entry and you want to go for, you know what, let's get an entry on the neckline break, the classic head and shoulders pattern or inverted head and shoulders pattern break. Get in, you're going to get in $5 sooner. In the big scheme of things, that's probably not that important. And that's the one thing that I have seen. I'm probably not choosing the best entries. I'm not taking pinpoint precision, picture perfects, running out of words that begin with P. I'm not picking the perfect spot. It doesn't matter in the big scheme of things. All we want is to trade the trend. I'm not worried about trying to catch the bottom. I'm trying to capture the big chunk in the middle. That's where trend traders make the most money. It's not by trying to find the top or the bottom. It's just trying to take a big bite out the bit in the middle. So it's not that discretion, well, discretion, the clue's in the name. Discretion can't be replicated. Layer it on, determine that you're going to place the trade anyway. And then if you happen to see something in addition, then you can layer it on. It's not essential, but if it makes you feel better, then do it. That's the way I think about discretion these days. Right, let's do it then. So we've chased plenty of squirrels today. Thank you for your time and attention. As usual, if you would like to work with more closely with me, you can do. My aim, as always, is to give you the right tools, the rules, the software that you've just seen. There is a community to help support you. It's not just me behind the scenes. There are lots of other people that are on the same journey. And if you like a mentor to show you the way, then I'm here when you're ready so that you can get real results right now. I would like to finish, as always, with a thank you. Thank you for spending some time with me here today. We could all be doing other things with our Friday mornings or afternoons, depending on where you are in the world. I just want to show some gratitude for you deciding to spend it with me. And if I could just beg your indulgence, what was your biggest takeaway? Was there an aha moment? Did you enjoy yourself? Is there any feedback? Let me know your thoughts. Or I'd be greatly appreciative of your thoughts. A couple of previous comments were, it's really easy when you know. There's always a good rule to follow. You can't manage your trade using too much analysis. The down through, the gan through. Again, all of those tools have their time and place, but it's just not essential to lead with the discretion. I'm not seeing any comments. Seems like everyone's a little bit not chatty today. That's no big deal. Sometimes that's just the way it is. So again, once again, thank you for your time. Thank you for your attention. I really appreciate the fact that you've decided to spend some time with me today. If I could just beg one more thing from you, just go and do it. There is nothing worse than sitting on your hands with what is clearly proven process that actually works to make money from the markets. I would just wish that you would go and do it. Because what you don't want to do is look back on the last 5 years, the last 10 years, for some people 20 plus years, and wishing that they'd got involved sooner. I started out when I was 16. I went full-time when I was in my early 20s, and I still wish that I'd done it sooner. And I didn't really. I'm very fortunate to get into it very early on, but some people can be at this for 5, 10, 15, 20 years and just not quite make it work. I don't care whether you use me as a mentor or a helper, but just get a mentor. You will get there further, faster, following in the footsteps of someone who's already done it. So if you've got everything that you need from today's session, that's great. Go and put it into practice. And if you need more help, shoot me a message. Right, with that said, let's do it. Game over. Thank you for your time. Thank you for your attention. This has been live stream, so it's ready to rewatch now. If you want to take some notes, please feel free to. It's up on the YouTubes. If you've got any questions, comments, observations from today's session, shoot me a message. If I've overlooked your question, that it was not intentional, unless it was, in which case you'll never know. But shoot me a message. My favorite place is Slack. I am quite active there. Just shoot me a direct message, as most people have been doing while I've been doing these sessions. It pushes through to my mobile phone. So if you want to shoot me a message, then again, please feel free to. Everyone generally puts some interesting comments there when they need something from me. Right then, with that said, let's do it. Thank you for your time. Let us land the plane and have a great weekend. And I will see you all at the same time, same place next Friday.